New global office demand data coming out from VTS. Some key points from the survey. London falling behind New York City for the first time, and the tech industry having a mass exodus. For more on the report, we're bringing in co-founder and chief strategy officer at VTS, Ryan Masiello. Ryan, it is good to see you. So we look to you, Ryan, for that office demand data. Maybe start, Ryan, with what you're seeing right here in New York City. What are the trends you're seeing both now and looking ahead, Ryan?
Yeah, so listen, New York is a market where the headlines are definitely not meeting the reality of what's happening on the ground. New York is a market that has led the recovery since the onset of the pandemic. And if you look at the VTS demand model, which helps us predict what will drive future leasing activity, it's saying that we're going to break 30 million square feet of leasing this year, which would just be a huge win for New York and for the office sector in general.
Ryan, can you break down that model specifically? I mean, is it based off of leases that you're seeing, or what exactly are you sort of breaking down that tells you that there is some optimism on the way?
Yeah, so what makes the VTS demand model unique is it looks across the 13 billion square feet that's being managed on our platform. And historically, commercial real estate is operated off a backwards looking demand set. So what deals have been completed? The way that we look at things is which tenants are actually in the market today, and how does all that come together, and how do we use that data to come together to forecast what we expect.
And how about swinging over the other side of the coast, Brian? How about San Francisco, where it seems like your data was showing you maybe some bright spots?
Yeah, I mean, San Francisco is a market that has got hit really, really hard. And it's a market that historically has been very resilient, and we're starting to see some positive signals. So over the past 12 months, we've seen 25% of net new demand growth. And just given the level and cost basis of the buildings in that market, we actually think it's going to be something that is very attractive for a lot of the institutional investors today.
Ryan, what is that demand for? Are we talking about smaller office spaces? Is it about demand for a hybrid model to accommodate something like that? I mean, yes, there's demand, but how is that different from what we saw pre-pandemic?
I mean, look, the big difference in San Francisco is obviously tech. You know, it's a market that is fueled by innovation, and tech is not only the industry that's holding San Francisco back, but really the majority of the country. And it has been one of the big differences in the resilience we've seen in London. So just to put that into perspective, on average, tech is 60% behind where it was pre-COVID, where in London, it's only 20% behind. So in the US and in San Francisco particularly, we really need interest rates to come down so that tech companies can start growing again and obviously have that impact.
But even those that are seeking out some of these office leases, I mean, we're talking about the same kind of footprint?
You know, look, if we look at our data today, we would say that on average, office footprints have shrunk by about 6% pre-COVID. It is a little bit more pronounced within the tech sector. But one of the things that we are starting to see is that a company's policy isn't necessarily impacting its footprint, right? So if a company is requiring people to be in 2 or 3 days a week, they're still going to need about the same amount of office space. And so we think that is what we're starting to learn about this work from home phenomenon.
And Ryan, to what extent do you think your data is giving us any insight about the kind of return to office trend, and whether that maybe is gaining more traction?
Yeah, look, I mean, that is a number where there's lots of different ways in which people are trying to figure that out. I think that a lot of that data is noisy. And so we do believe that the best way to understand, a company, really the long-term health of the office market and how hard people are pushing to get back is just by looking at the commitments they're making to office leases. So again, our data tends to lead leasing activity on average by 9 months. And we have seen a 27% increase in the overall demand that is back in the market this year. So bringing the current demand levels to about 65% of pre-COVID levels. And so I think that's starting to signal that companies are working their way back and are going to start to become long office space once again.
Ryan, what kind of lease terms are we talking about right now? I mean, I'd imagine that they are shorter leases given just where demand has been, but also in terms of pricing, how significant a discount are we looking at?
Yeah. So this is an interesting one. So what happened post-pandemic is a lot of companies wound up signing short-term leases, right? Every lease was about 2 or 3 years old. what we have seen now is a lot of companies actually trying to take advantage of what they know is probably the bottom of the market. And so we're starting to see lease terms on average move back up to 5, 7, 10 years. With respect to rents, on average, net effective rents across the core US markets are down about 12%. And obviously that's going to vary depending on the submarket, the building quality, et cetera. But the interesting thing has been in this cycle has been flight to quality. So in markets like New York, we're seeing the top 10% of assets actually overachieving their pre-COVID rent levels, and net effective rents are up about 17%. So those are the earliest signals that I think start to tell us that we're at the bottom of the market. And so for a lot of companies, it is all about trying to figure out how to take advantage of that.
Yeah, up 17% certainly points to a bit of a comeback we're seeing right now. Ryan Masiello, good to talk to you today. Appreciate the time.
Thank you.